Revaluation model. The revaluation model is an alternative to the cost model for the periodic valuation and reporting of long-lived assets. What we talked about in section 3 essentially was the cost model, where you initially record your equipment at cost and then you depreciate every year. The revaluation model, as indicated here, is an alternative, and the main point with the revaluation model, as this name implies, is that you are allowed to revalue the asset. IFRS permit the use of either the revaluation model or the cost model. US GAAP does not allow the revaluation model. So this is purely a IFRS concept. Revaluation changes the carrying amount of classes of long-lived assets to fair value. All this is saying is, if you initially purchase an asset for 1,000 and after 2 years the fair market value of this asset has gone up to 1,200, then you can revalue the asset up to 1,200, and then the depreciation will be based on this revalued amount. Companies need to be careful when using the revaluation model. This should be used when the fair value is very easily determined through market prices. If fair value cannot be easily determined and requires a lot of subjectivity, then it is better to use the cost model. As an analyst, you need to be very careful when companies are using the revaluation model because of the subjectivity involved in coming up with the new value. Carrying amounts with the revaluation model are the fair value at the date of revaluation less any subsequent accumulated depreciation or amortization. So in my example here, once the machine was revalued to 1,200, then after that we do depreciate and the carrying value will be 1,200 minus any accumulated depreciation. Let us look at an example which illustrates the concept of revaluation. A machine costs 10,000 at the start of period 1. At the end of period 1, the fair value of the machine is 12,000. So we have period 1, we start at 10,000 and then revalue at 12,000. In period 2, the fair value is down to 8,000, so we need to revalue downwards. How is this shown on the financial statements? Initially, our asset is shown at 10,000. After revaluation, our asset goes up to 12,000. So that's an increase of 2,000. How do we make the balance sheet balance? When the value of the asset goes up, we also need to show this on the equity side. On the equity side, there is a category called revaluation surplus that is increased by 2,000. Just as the asset value went up by 2,000, similarly on the equity side we need an increase, and that increase is shown as a revaluation surplus. This is a component of equity. In year 2, the value goes down. Now the fair value is 8,000. The asset has to be written down from 12,000 down to 8,000. So that essentially is a decrease of 4,000. How do we do this on the equity side? The first thing that we do is we reverse the revaluation surplus. So that comes down by 2,000. And then the additional 2,000, the difference between 10,000 and 8,000, that is shown as a loss on the income statement. 2,000, and then this flows through retained earnings, which also reduces equity. The overall impact would be that equity would be down by 4,000. Note that gains do not flow through the income statement. They go straight to equity and are recorded under revaluation surplus, whereas losses, and these are losses that take us below the original cost, those are shown on the income statement as a loss. In this example, we simply have the value going down first. So in period 1, we go from 10,000 down to 8,000. And then in period 2, we go from 8,000 up to 12,000. How does this work? Notice that in period 1, the value goes down. So the asset value goes down by 2,000. This decrease is shown as a loss on the income statement of 2,000, and then through retained earnings we have a decrease in equity of 2,000. In year 2 there is a gain. With the gain we first reverse the 2,000 amount. So on the income statement we will have a gain of 2,000, and then the additional 2,000, which is the difference between 12,000 and 10,000, that is shown as a revaluation surplus, which is part of equity. So this 2,000 does not flow through the income statement. Impairment of assets. Impairment charges reflect an unanticipated decline in the value of an asset. Both IFRS and U.S. GAAP require companies to write down the carrying amount of impaired assets. Impairment reversals are permitted under IFRS but not under U.S. GAAP. A quick distinction between impairment and depreciation. Depreciation is an expected or planned decrease in the value of an asset. Impairment, by definition, is an unanticipated decline. If you have a piece of equipment worth 1,000 and because of an earthquake there is damage to this equipment such that the value is now down to 900, the decrease from 100 to 900 is called impairment, and this loss is going to be shown on the income statement. Let us understand impairment related calculations in a little more detail, and then we will do an example. Under IFRS, the impairment loss is equal to the carrying value minus recoverable amount. Carrying value is the original carrying value of your equipment. Let's say that number is 1,000. After the machine has been damaged, let's say because of an earthquake, an unexpected or unanticipated event, the recoverable amount might be less than 1,000, which means that we need to show a impairment loss. The question then is, how do we come up with that recoverable amount? The recoverable amount is the greater of two numbers. Those two numbers are fair value less cost to sell and value in use. This term should look familiar. In the previous reading on inventory, we talked about the concept of net realizable value. That concept is used with inventory. The same concept is also used here, but it's just not called NRV. Here we call it fair value less cost to sell. If the fair value of this machine after it has been damaged is equal to 900 and it would cost 50 to sell the machine, then the recoverable amount is 850. So we compare 850 with the value in use. The value in use is defined as the present value of the cash flows that this asset will generate. Let's say that the present value of the future cash flows is 900. Then the recoverable amount is the greater of these two numbers, which is 900. And that would mean that according to IFRS, our impairment loss is going to be 100. Essentially, what we'll then do on the balance sheet is write the asset down from 1,000 to 900, and on the income statement we will show a loss due to impairment of 100. US GAAP is a little different. With US GAAP, we first do the recoverability test to determine whether the asset is impaired. An asset is impaired if the carrying value is greater than the asset's future undiscounted cash flows. If we say that the carrying value is 1,000 and we look at the future cash flows that will be generated from this asset, let's say that the future cash flows, the undiscounted amount is 1050. Since this number is greater than the carrying value, then there is no impairment. On the other hand, if the undiscounted cash flows are less than 1000, then we would say that there is impairment. This in essence is a litmus test which is telling us whether or not we need to worry about impairment. Let's say that instead of 1050 we had 950 as our undiscounted cash flows. That means that the asset is impaired. The next step would then be to compute the impairment loss. The impairment loss according to US GAAP is the difference between fair value and carrying amount. Let's say that you are given the fair value of 800 and let's say the carrying amount is equal to 1000, then the impairment loss is 200. Let's say that we have a machine where initially the carrying amount is 8000. The undiscounted expected future cash flow is 9000. Present value of expected future cash flows 6000. Fair value if sold 7000, cost to sell 200. What you need to do is say what value will be reported on the balance sheet under IFRS and what will be reported under US GAAP. And along with that, you need to show what the impairment loss will be that will be shown on the income statement. Under IFRS, here is what you need to do. You know that the carrying amount is 8000. You need to come up with the recoverable amount. And if you recall from the previous slide, the recoverable amount is the greater of two values. One of those values is the fair value less cost to sell, that is like the NRV concept. The fair value less cost to sell is 6800. We compare this with the present value of expected future cash flows. That number is 6000. The recoverable amount is the greater of these two numbers, which is 6800. On the balance sheet, we need to write down the machine from 8000 to 6800, and on the income statement we will show a loss of 1200, which is the difference between these two numbers. With US GAAP, we need to do the recoverability test, and essentially what the test says is that you have to compare the undiscounted cash flows, which equal 9000, with the carrying amount 8000. In our case, the undiscounted cash flows are greater than the carrying amount, therefore there is no impairment. So US GAAP will say that we keep our asset at 8000. Coming now to other impairment scenarios, I don't think this material is overly testable. It is covered very briefly in the curriculum, so I won't spend much time on this either. Impairment of intangible assets with a finite life. The rules here essentially are similar to what we talked about earlier with tangible assets. Impairment of intangible assets with indefinite lives. This essentially is referring to goodwill. We need to periodically test whether or not goodwill is impaired. Impairment of long-lived assets held for sale. Essentially, this is saying that if a company has equipment which was originally intended for internal use, but now the intent has changed where this asset is going to be sold or the intent is to sell, then it needs to be reclassified as held for sale. Reversal of impairments. We've mentioned this before, and this is a little bit important. Under IFRS, if you impair and the value comes down, after that for some reason the value goes back up, then you can revalue back up till the original value, even though the market value or the fair value is higher. But when you come back up, you can only come up to the original amount. Under US GAAP, you can go down, so revalue downwards, but then you cannot revalue up. And this should sound familiar. We talked about something similar when we covered inventories in the previous reading. Derecognition. A company derecognizes an asset, which means the asset is removed from the financial statements when the asset is disposed of or is expected to provide no future benefit from use or disposal. In other words, the asset is now useless. A company may dispose of a long-lived operating asset by selling it, exchanging it, or abandoning it. When a company sells an asset, the gain or loss on sale is equal to the sales proceeds minus the carrying amount. This is fairly straightforward. If the asset is sold for 12 and the carrying amount is 10, then we show 2 as a gain on the income statement. Long-lived assets disposed of other than by a sale. If you abandon an asset, this essentially is like a sale with zero proceeds. You would abandon an asset if it is now in a state where nobody is going to buy it from you and it is of no use to you. Let's say that the carrying value of that asset is 2. That asset is now being removed from the balance sheet. So the carrying value essentially is going to be written down from 2 to 0. 0 means that the asset has been removed from the balance sheet, and the loss of 2 is going to be shown on the income statement. Exchanged assets. You have asset A. This has been exchanged or replaced by asset B. What you do is remove the carrying value of A from the balance sheet. So if A has a carrying value of 10, B has a carrying value of 12, you remove 10 from the balance sheet and you bring B onto the balance sheet at the fair value of 12. So essentially you have total assets that go up by 2 in this particular scenario, because an asset worth 10 has been replaced by an asset worth 12. That gain of 2 is shown on the income statement as a gain. Long-lived assets are disposed or removed from the balance sheet of a company if there is a spin-off. In a spin-off, the assets are distributed to owners. Generally, with a spin-off, an entire cash-generating unit of a company with all its assets is given to the owners, and this typically does not result in any gain or loss. Presentation and disclosures, you can read this. I don't think it's overly testable, but as with other items on the balance sheet, there are requirements about what needs to be presented, what needs to be disclosed in the footnotes, and so on. I would suggest that you read this. The disclosures related to impairment losses are different under IFRS and U.S. GAAP. And just as a quick reminder, if we have a long-lived asset and for some reason this is damaged, and based on that damage we reduce the value of this long-lived asset on the balance sheet, that's called an impairment, and the loss associated with reducing the value is called an impairment loss. Under IFRS, a company must disclose for each class of assets the following information: the amounts of impairment losses and reversals of impairment losses recognized in the period, and where those are recognized on the financial statements. So notice under IFRS, we are allowed to reverse impairment losses, but these reversals need to be very clearly disclosed. Under IFRS, we also need to disclose the main classes of assets that are impacted by the impairment losses, as well as reversals of impairment losses, and the main events and circumstances leading to the recognition of these impairment losses and reversals of impairment losses. Under US GAAP, reversal of impairment losses for assets held for use is not permitted. So this is a major difference between IFRS and US GAAP. Under both IFRS and US GAAP, impairment is allowed. IFRS does allow the reversal of an impairment under certain circumstances, but a reversal of impairment is not allowed under US GAAP. With respect to disclosures under US GAAP, we need to provide a description of the impaired asset and what led to the impairment, the method of determining fair value, and the amount of the impairment loss, and where the loss is recognized on the financial statements. Investment property is defined as property that is owned for the purpose of earning rentals, capital appreciation, or both. In other words, this investment property is not part of the regular operations of the company. Under IFRS, companies are allowed to value investment properties using either a cost model or a fair value model. The cost model is identical to the cost model used for property, plant, and equipment, but the fair value model differs from the revaluation model used for property, plant, and equipment. Under the fair value model, all changes in the fair value of the investment property affect net income. Under US GAAP, investment properties are generally measured using the cost model. Let us look at a simple example, and this is something that I have not seen anywhere else, but I thought it is useful to bring together some of the models that we have talked about in order to minimize any confusion. In an earlier reading on the balance sheet, we talked about unrealized gains and losses on securities that are tagged as AFS. Earlier in this lecture, we talked about assets valued using the revaluation model. And here we are talking about the fair value model. All these are models that allow us to define the value of an asset on the balance sheet, and these models also need to tell us how gains and losses need to be shown, specifically unrealized gains and losses. This is a bit of a revision, but with AFS securities, we essentially said that the asset is shown at fair value on the balance sheet, and any gains or losses are shown straight in equity. They do not flow through the income statement, so they are shown in equity as part of other comprehensive income. Then we talked about the revaluation model earlier in this lecture, and there we said that assets need to be shown at fair value when they are revalued. But there is a difference in how we deal with gains and how we deal with losses. Losses need to be shown as a loss in the income statement, whereas gains are shown as equity, so straight in the equity segment as a revaluation surplus. This is part of other comprehensive income. So notice with the revaluation model, gains and losses are treated slightly differently. We need to use both the income statement as well as OCI. With the fair value model, what we are saying is, obviously, since it's called the fair value model, the assets are shown at fair value on the balance sheet. And the difference here is that all gains and losses are shown on the income statement. So there are subtle differences between these three models, and on this slide we have summarized those differences. We will now summarize this reading. As I mentioned before, this is largely a repeat of level 1, so it is fairly straightforward. You need to understand the impact of expensing versus capitalization, and specifically the impact on financial statement elements and ratios. The impact of depreciation, especially straight line depreciation versus accelerated depreciation, the impact on the asset numbers and then various ratios, as well as income statement impact. Then the impact of impairment and revaluation on financial statements and ratios. You need to know the financial statement disclosures regarding long-lived assets and how you as an analyst can take advantage of these disclosures. You can come up with the estimated remaining life, You can come up with the total life and so on. As always, I want you to read the summary, review the learning objectives. I have covered the examples, some of them, but you need to go over the examples also, and then if you have issues, look at the curriculum or look at the example videos. Do all the practice problems, this is critical, and if you have time, then do practice questions from other sources as well.